We are live and looks like we're recording.
Awesome.
Perfect. All right, Nikki.
All right. Well, good morning, everyone, and happy Monday. So we have some interesting things going on with mortgage interest rates right now. So there has been a emerging pattern in October that has happened the last 2 years, and we're seeing this pattern happen again. So they're starting to call it the October effect, where basically the first 3 weeks of October over the last 2 years, we've seen a sharp increase in interest rates over the first 3 weeks. Then all of a sudden, on the 21st or 22nd of October, those interest rates and the increase that we've seen all goes away and they start coming right back down. So October for the last 2 years has been historically the highest point of the 10-year treasury bond for the year. And so basically it'll go all up, 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 it'll reach its peak, and then it'll start to come back down. We're hoping that this is the third year in a row that that happens. Obviously, we have to wait and see. There are some interesting numbers coming out next week, not this week, but next week, which are going to help us make some predictions on what's going to happen for the rest of the year. Mainly, the PCE and the CPI numbers and the jobs report is coming out again next week. So we are waiting, kind of anticipating, waiting to see what happens. And if we get an additional improvement in those interest rates over the next week, over the next couple weeks, as we head into the election. As a reminder, the next Fed meeting is November 7th, which is 2 days after the election, and where the Fed is planning on dropping interest rates again. We haven't seen any of that start to be baked into the market yet. Usually we'll see interest rate improvement before there's a scheduled drop by the Fed, but we aren't really seeing that as of yet. So it's yet to be determined what's happening. We're kind of waiting in limbo this week. With that being said, from a mortgage application standpoint, applications are up. Surprisingly, even with the interest rate increases, they started to come back. So we had a dead week and a half in the beginning of October, and now we're starting to see an increase again in those mortgage applications. So which is good news. Other than that, a couple of things I wanted to mention from a mortgage standpoint, just on the streets. First and foremost, we're seeing an increase in the cost of appraisals nationwide. So we used to be able to get appraisals done most of the time for under $500. Now we're seeing that appraisers are starting to give a little pushback, and they're wanting $550 or $600 at minimum for appraisal. So just something to keep in mind as you have buyers that are out there in the market and sellers, is that there is a small increase that we're seeing in appraisal costs, just like everything's increasing in cost over time. So something to keep in mind there. Also, one interesting point of feedback that we heard from an appraiser that we've heard a couple times is, if you have a property that is a little bit more complicated or a little bit more unique, or something where you said, you know what, I had to dig really deep to get comps for this property to price it for listing for sale. If you take your list of comps that you used in order to justify your list price and just leave them on the counter for the appraiser, that is going to be extremely helpful for them. It makes their job easier, helps them understand where you were coming from a listing price, and helps if in case they have comps that they didn't see and you guys have them. It helps with value. It helps us prevent having to do a rebuttal, things of that nature. So keep that in mind as you have properties that are either you've had some difficulty pricing, or that are more unique in nature, such as, maybe it's a manufactured home, maybe it's got acreage, maybe it has, some of those more unique features to it, newly remodeled, not in an HOA, things of that nature that are going to kind of be a little bit more unique, that you want to kind of help with the appraiser to give them the comps that you used in order to list it. Now, that's not to say they're going to use them, but it does give them feedback and says, okay, this is what I used to price that property. FYI. The other thing I want to talk about, I already did a TikTok and a reel on this week, but I wanted to really mention it on this call as well, is the changes to Freddie Mac's automated underwriting system. So when we go to lend on a conventional mortgage, we use either a Fannie Mae lending product or a Freddie Mac lending product. They both have similar guidelines. There's some more flexibilities with Freddie Mac than there aren't with Fannie. But when we go to approve somebody, we run them through the automated underwriting system for Freddie Mac. It's called LP, or Loan Prospector. What that does is it takes into consideration credit score, loan to value, income, things of that nature, puts all those pieces of the puzzle together and spits out a result that gives us either an approval or a refer with caution. And what a refer with caution basically means is that there's something in the profile of the client, whether it be credit score, income, debt to income ratios, things of that nature, that it's not going to give us an underwriting approval for, an automated approval for. So we have to try to figure out what that is and try to help solve that situation so that we can get an approval. Prior to October 13th, when LP would give us a refer with caution message, it would give us messaging that was a little bit unclear as to what the actual problem was. It would say something like, we don't like your debt to income ratio, or your credit score isn't high enough, or it would say, it would give a generic message about not meeting the risk classification for approval. And we as loan officers would have to then go back and try to make adjustments on reserves, or try to make adjustments on, if we could do some things to improve credit score, and kind of have this guessing game as to what's going to help that client who got a refer with caution end up with an approval so that we can give guidance. Well, on October 13th, LP released their new messaging, which actually gives us more specific information on how to get people who have a refer into an approval status. So instead of saying, we don't like your loan to value, it'll say you submitted this with a loan to value of 97%. If the client has $10,000 more in down payment, you should be able to turn this into an approval, or it will help turn this into an approval. Or your debt to income ratio was 43%. If you're able to reduce the debt to income ratio down to 41%, you should be able to then therefore get an approval. Or it'll talk about housing ratios, but it'll give us more clues as to why clients who are not getting approved, why they're not getting approved, and what we can do to help them with that approval process. So this will be super helpful, because for those clients, like a lot of times when we get that refer, what we're doing is we're then sending them over to an FHA lending product. So, government-backed lending for FHA, where the fees are higher, the mortgage insurance is normally higher, and it just is a little bit more expensive of a loan. This will help us kind of push more people into that conventional buying for not only your pre-approvals, but when they're offering on homes and things like that. So really good adjustments, really good improvements from Freddie from that standpoint. And we just used it on our first loan last week, where we could not get an approval for this client. No matter what we did, the only way we could get an approval was to have it with 20% down. Well, we went back into Freddie Mac and we reran the findings, and it actually told us that if we have $6,000 in reserves, we should be able to put less of a down payment down. So we switched it over to 5% down, included additional reserves that the client had in a retirement account, and we got an approval for that client. So I know that it is working, and it is helping us kind of change some of those FHA approvals over to conventional approvals because we have that messaging. So a really good enhancement from them, and it's going to be helpful for us and for your buyers more on a long-term basis.
Yeah, that's amazing. So with the agents either on this call or watching the replay, what clients should be coming to mind that we should get in contact with you right away and have them reran through this system?
Yep, any client that has been pre-approved as an FHA buyer, for, even if it's an unknown reason why they had to go FHA, see if we can turn that back into a conventional loan, or any client that wasn't able to become pre-approved and there was a little bit of a mystery as to why. Well, maybe you need to save more, maybe you need to pay down this debt, maybe you need to do this or that, and we can help answer those questions for them.
Yeah. Love it. Any questions for Nikki? And I don't have the live stream in front of me, but I think oh, go ahead.
Hi. Yeah, I'm just wondering, like, when our clients already talked to a lender and the lender is saying their credit is not where it needs to be, but they were working with that person. But then the client said she went to a bank and looked at her scores and it was up there around 649. I'm just wondering, like, what is it like the bank is, how
So
can I tell
they
if
went
that
to their
client?
original lender and they got a lower credit, or they said the credit score was lower, and then they went to the bank
Yeah.
and the bank said it was at a little bit higher?
Yeah.
Okay, so there's a couple reasons that can happen. Depending on who they went to the first time as the lender, they may have an overlay or a minimum credit score requirement that all borrowers have to meet. So for example, there are lenders that will lend on mortgages down to a 500 credit score. And there's also lenders that will say, okay, we need a minimum of a 600 credit score in order for our institution to lend. So it really depends on who that lender is and what their minimum credit score requirement is. That could be one reason. The second reason could be when you are at a bank, depending on how they do their mortgage lending, they may only pull the credit score from one bureau. They may not pull all three. So we pull all three, for example, and we use the mid score. So in other words, let's just say they had a 620 with TransUnion, a 640 with Experian, and a 660 with Equifax. We use that mid score of the 640 for qualifying, and we pull all three bureaus. Okay. Sometimes, depending on the bank, they may only pull one or two. And if they're pulling one, for example, and that one might be the high one that they pulled at the 649, and her other two scores might have been lower. Does that make sense?
Okay.
Depending on
Okay.
which lender she is. So not all lenders and all banks are the same. So another example of this is today I actually got a call from a client because they had been turned down for a loan from a bank because the property that they wanted to purchase was a manufactured home. The bank does not lend on manufactured homes. We do. We lend on anything that Fannie Mae and Freddie Mac will lend on. But the bank has said, okay, no, we will not do this as an overlay. We won't do it. So it really depends on where they're going and who that they're talking to from a credit score standpoint and how that institution is pulling their credit. And what if they're pulling from all three bureaus or not.
Is there
Okay.
any rule of thumb or anything that we should know as agents with who does what, or if a bank does this or that, or a lender? It just sounds like you could get 5 different opinions from 5 different sources.
You can. So that's kind of where there's a lot of confusion, and that's where there's a lot of education needed for the client. There's a huge difference between bank lending and secondary mortgage lending. Huge difference. Bank lending is going to be with a bank product. So for example, you walk into Wells Fargo, you get a Wells Fargo mortgage. You walk into Chase, you get a Chase mortgage. You talk to somebody at Wings, you get a Wings mortgage, if that makes sense. So on when you have a banking institution, most of the time their mortgage lending is mortgage lending for that particular product. The same thing goes for a credit union. Credit union has credit union lending. Okay. So a lot of what's happening in the bank side of things is that they are using their deposits. So in other words, the people who are depositing money, they use that cumulative amount to lend against from a mortgage perspective, and it's all done in-house. That's usually the bank lending, with the way that they lend on their own products. From a secondary market, or what I do is I have access to Fannie Mae, Freddie Mac, Chase, Wells Fargo, you know, New American, PennyMac, all these different lenders I have access to. And what I do is I sit there and I say, okay, if this client is qualified on for X amount of dollars with X credit score, with X income, et cetera, et cetera. I put all those pieces together and I go out into the institutions and I say, okay, who's going to give me the best price for this particular lending client? So I'm not using my deposit funds to lend to people. I'm using a line of credit where I lend people on that line of credit and then I sell that mortgage or sell that paper to that in-servicer. So for example, if someone came to me and said, hey, I need a mortgage, I have a 640 credit score and I want to see if I can get qualified conventionally, I can help them get qualified conventionally at that credit score. And then I take that and I say, okay, which lender is going to allow me to which lender is going to take this at a 640 credit score, who's going to accept payments for this? Who can I sell this to? So there's a huge difference between the two because on the secondary market side, there's not overlays. There's a lot of flexibility when it comes to lending. And if you lend directly to Fannie Mae and Freddie Mac, that's where you're going to have the least amount of red tape when it goes to get somebody qualified. And then I'm just looking for somebody who will take that for the best price that I can offer the client on that day. Does that make sense?
Absolutely. And I just wanted you to explain that because I think that a lot of agents don't understand that. And so I know when I was meeting with buyers in my buyer consultation, I would often, a lot of times they wanted to go with their bank. And I explained it a lot like you walk into the bank, you walked into that brick building and you are confined to that brick building, that bank's products.
Yep.
Whereas if you go with you get, it's like going from like 6 to product options to 32, or, you know, just,
Yep, exactly.
percentage wise. So I think it's just really important that we understand that. And I always said, you know, whom you go with is your decision. My role is just to make sure that you get the best program, interest rate, and home for you and your family. So go to your bank and go to Nikki and, you know, see which one, you know, get more than one option. And I think Aminata, I hear you saying that they are doing that. So that's perfect. But then it's asking the question and then taking the answer and kind of unwinding it or unraveling it to really understand what's going on. And it kind of sounds like the new messaging that's coming through now, when you do run someone through that automated underwriting system, is more specific about what needs to happen based upon the results, where it hadn't been that specific before.
That is correct. Yeah. And, you know, a lot of the banks will hold that money or hold that lending within the bank. And sometimes there are banks that do have access to secondary market, but even when they do, it's not a lot of investors. It's usually like 3 or 4 where I have access to like 70, you know, so it just depends on, you know, really the bank and what their experience is.
Love it. Does that
Can
answer
I
your
bother
question?
you? Yeah, can I bother you with one more here?
Yes.
Yeah, so just my vehicle, I'm trying to see where my leads, you know, the farming I'm doing, and I went on there and I checked. Usually like with RG, it's connected with the email and all that. Not finding nothing.
For a farming tool you're using?
Well, I no, like to like when you get a lead, it's supposed to go on my KV call or connected with the email, but I'm not getting that. So I'm trying to see. I went on KV call and I've looked and I'm not seeing where can I find that.
Okay, we can take that offline. Let's connect, Aminata, and I will get you into the KV support so we can get that figured out because you definitely want that done. Yeah.
Yes, thank you.
My pleasure. Yes. Any other questions? I know we're at about the 20-minute mark and I want to keep it to time. All right. Well, thanks so much, Nikki. I know next week, Nikki and Cari will be at EXPCon. However, I will be here. I will bring, Nikki's always texting me when not live on the call, what we need to know. And it sounds like there'll be an update for next week. So be sure to tune in and I'll go over a few business planning strategies and things to start thinking about as we're in quarter 4 and headed into 2025.
Sounds great.
All right, everyone, have a
Thank
great
you.
rest of your day and let us know if we can be helping in any way. Aminata will connect offline.
Okay,
All right. Bye,
thank you.
everyone.
Bye-bye.
Bye.